Nomura expects Malaysian corporate earnings next year to be affected by weaker exports amidst lower crude oil prices. Presenting its outlook for 2015, Nomura says the earnings growth for the Malaysian market will be down to the 2 to 3% level. Part of the reason for this, according to its managing director Michael Kurtz, is because Malaysia has a lot of exposure to countries like China and Australia, whose economies are slowing down.
We are looking ourselves for only 2 to 3% earnings growth on the Kuala Lumpur market next year. Malaysia is a very export-driven and export-intensive economy, but unfortunately much of its exports are either in the wrong kinds of goods or to the wrong economies. So Malaysia has a lot of exposure, for example, to the Chinese economy, which, as I said, is slowing down. A lot of exposure to the Singaporean and Australian economies, and Australia, we think, also faces relatively weak prospects next year. So we don't see Malaysia as particularly leveraged to the particular areas of global demand growth that will drive earnings upside for other markets in the region, like Taiwan, for example.
Kurtz, however, said the valuation of Malaysian shares is at a discount to some of its ASEAN peers. On the outlook for crude oil prices, Kurtz said there will be some stabilization as early as the second quarter of next year. The stabilization will be driven by the acceleration of the US economy and some curtailment of global crude oil supply.
As oil prices linger below $70 a barrel, eventually some global producers will have to stop producing because it's unprofitable for them. Having said that, I still believe, however, that if we think in terms of a kind of a balance of risks to the upside and the downside around the oil price view, that the balance of risks is probably to the downside. And the reason I say that is because of the dollar influence on oil prices.
Kurtz said a stronger dollar, as was the case from 1996 to 1999, may continue to drive oil prices lower. Joshua Lim, DHTV.